morning, everyone. My name is Suzanne Templin, and I coordinate the webinars for Houseman Johnson Insurance. I would like to welcome you to today's ACA Update webinar presented by Pat Kelly. Yikes. Sorry about that, everybody. Today's webinar will run about 30 minutes. After the webinar, we will have a question and answer session. If you have a question during the webinar, feel free to type it into the question feature and Pat will address it during the Q&A portion. After the webinar is over, there will be a short survey we are hoping you can fill out for us. Also, please be aware that this webinar is being recorded and will be available for review on the webinar archives of our website. If you do not want to participate in a recorded webinar, you should close the application at this time. You will receive a follow-up email from us later today or tomorrow. I would now like to introduce you to our presenter for today's webinar, Pat Kelly. Pat has been with Houseman Johnson Insurance since 2011 and has over 30 years of experience in employee benefits. He is passionate about building a relationship with clients beyond just being a product vendor. He forms client connections through honest communication, continuous education, and always doing what he says he is going to do. Pat works with employers of all sizes and with both fully insured and self-funded medical clients, including defined contribution, HRA, HSA, and FSA. He also works with clients on their disability, life, dental, and vision needs. He has a wealth of knowledge on this topic, and we are very thankful that he could share some of his wisdom with us today. Welcome, Pat.
Thank you, Suzanne, and welcome everybody else out there. Affordable Care Act update. Again, we're going to be updating the Affordable Care Act. If you want, we don't have, as you know, there have not been a lot of changes in the Congress due to them not being able to get anything passed. But please, if you can, stay on board. We do have information that is part of the Affordable Care Act that we'll be updating for the coming year, 2018. We're going to have stuff for small employers. I'll have stuff for the large employers, and then we'll have information for all employers that affect everybody. So a little bit of history, what's happened so far in the Congress. As we all know, earlier this spring, the House passed what they called the American Health Care Act. Although it did pass, it passed by a slim margin. Well, since then, the Senate did not pass anything. They've had a couple bills that they pulled before they voted, and then their final bill, what they call the Better Care Reconciliation Act, was not passed. So that failed. So right now, there's really nothing going on in the Senate to get anything passed. You hear a few things every now and then. I get a lot of stuff through emails saying that, oh, we're going to meet again and vote, but we're not hearing anything. And really, a lot of people don't think anything's going to happen this year. Even if the Senate does pass a bill this year, remember, it's going to be a different bill than the bill that was passed by the House. So even then, it needs to go back to conference. And then that's when the House and the Senate, they go to conference, they try to put together a bill that will, again, pass the House and then move on and pass the Senate. A lot of people don't think that's going to happen this year. So what does that mean? The ACA is still the law of the land, alive and present. But even with this, we're hearing from employers and other people out there that say, hey, what about the executive order that President Trump issued that he signed on his first day after being inaugurated, January 20th, 2017. A lot of people, not a lot, but we're hearing out there that people are saying, doesn't that order kind of take the bite out of the individual mandate, the employer mandate, all the reporting? And it doesn't. What that order did, and I'll read it right here. I don't like reading just off PowerPoints. I like discussing, but for this, I'll read it. Basically, the order directs HHS, that's Health and Human Services, and the heads of other departments and agencies, such as the Department of Labor, the Treasury Department, to exercise all available authority and discretion to waive, defer, grant exemptions from, or delay the implementation of any provisions of the ACA that would impose a fiscal burden on any state or a cost, fee, tax, penalty, or regulatory burden on individuals, families, healthcare providers, health insurers, patients, recipients of healthcare services, purchasers of health insurance, or makers of medical devices, products, and medications. Sounds far-reaching, but something was missing from that executive order. We don't have a question and answer thing here. It's not live, but anybody wants to come and try to say who was missing from that order. If you look back, it talked about a lot of different individuals, but there was somebody missing from that order: employers. Employers were not explicitly mentioned in that order. You can go back and say, well, are employers purchasers of health insurance? They are, but I also want to go back and say that employers were not explicitly mentioned when we talked about individuals, families, states, and so forth. So that's one thing. And actually, because of another law that's out there, the order is somewhat just a symbolic order. It has no immediate effect on current ACA regulations that employers and individuals have to deal with. The reason why that is there's something out there called the Administrative Procedures Act, acronym APA. Basically what this act does is states that agencies, IRS, the DOL, HHS, cannot rescind existing regulations until they engage in a new notice and comment rulemaking process. And that's including a required public comment period and delayed effective dates, and observe other procedural requirements. And just to back this up, back in April, again in the spring, the Office of Chief Counsel issued a series of information letters clarifying that the ACA's individual and employer mandate penalties continue to apply. So what that means is, the executive order basically has no teeth whatsoever. It can delay future regulations that haven't been implemented yet, but any regulations that we're currently dealing with, it cannot delay or it cannot change unless they go through that APA process. So now we'll just get in to the update for the ACA and how it affects small employers. And again, large employers, bear with me because, I'll get to you shortly, and small employers hang in there when I get to large employers because there's some ACA rules out there that affect all size employers. One thing that we've been working with and your small employers are familiar with, the transitional relief plans have now been extended out again, and now they're extended out to December 31st of 2018. So plans that are coming up for renewal the end of this year, November, December, obviously January renewals, you will be able to renew again and keep your current non-ACA transitional coverage if it's financially efficient to do that. Some ACA plans are getting closer to the rates that some transitional plans have, and that's just something we need to work out with your agent and decide moving forward which plans are best for your individual situation. But you will not be forced to go to the ACA community-rated plans like we thought last year at this time. So that's good news. But the other thing you got to be careful of and work with your agent on is carriers have specific guidelines on how they're managing this transition relief. Not all carriers are following the same guidelines or allowing the same thing. So for the most part, your agent understands that, work with you on it, and work with you through your renewals that will be coming up at the end of this year and January 1st. The other piece out there that we hear about, people asking about, and actually this was signed by Obama back in December, and it was part of what we call the 21st Century Cures Act. He did allow HRAs for small employers to be used to help reimburse medical costs and premiums. So what he signed in the 21st Century Cures Act. The program is called a Qualified Small Employer Health Reimbursement Arrangement. Now, I'm not going to go deep into this law personally, because I think for all the restrictions and all the regulations, if you don't have coverage, or if employers are not providing any benefits to their employees today, small employers are not providing any benefits, this might be a good thing. But if employers are currently providing group benefits to their employees and they think this would be an alternative, this is where I think it has more cons than pros. First off, you as an employer, you cannot have a group health plan and a qualified small employer HRA. So if you're going to offer the HRA, you have to drop your group health plan. If you do that, your employees won't have the tax deductibility of the portion of the premium they pay, and they may pay taxes on the HRA reimbursement. That may part is, let's say you have an employee that tells you, well, I do have an individual plan, it meets the guidelines, for me to receive the HRA reimbursement, but then mid-year they decide, yeah, I'm going to drop my individual plan. Now they have to have an individual plan that meets minimum essential coverage. So if they drop that HRA could become taxable then to them. So those are the two things that we do have. And that tax deductibility for your employees is huge when they pay those group health insurance premiums, their share. The reimbursements to the employee will be a direct offset to any federal marketplace premium subsidies the employee may be receiving. So if you have a group health plan now and you're a small employer and you have some employees that maybe aren't on your coverage and they've gone to the marketplace because of the subsidies they can receive, well, if you move forward with this type of plan, any amount that you decide to reimburse, let's say you decide to reimburse up to $200 a month to your employee, and that could be for medical costs or insurance premiums for individual coverage. Well, if you make a $200 reimbursement and they're getting a $300 subsidy from the marketplace, that subsidy is going to shrink to $100. So they're not going to be any better off with that. Obviously, if you have employees that haven't even gone to the marketplace and now they feel they can because of the help, yes, that's an area there it might help, but it really doesn't help those employees who are receiving any current federal subsidies. And just like anything else that we get from our federal government, there are employer and employee annual reporting requirements. The employer needs to notify employees 90 days out at January 1st at open enrollment time for the marketplace. Employees need to, if employees are receiving subsidies or premium subsidies from the federal government through the marketplace, they are going to have to tell the marketplace that now my employer has a qualified small employer HRA and I'm receiving this amount of money, because the marketplace then will offset that subsidy by the amount that the employer is contributing. So these are just like 4 points on the surface. I feel that why we don't just jump into these right away. If anybody wants more information on who's eligible, what employees are eligible, things like that, and I'd love to have further discussion on it and so forth. Large employer update coming up for 2018. The affordability calculation for the health plan, that percent will be 9.56. Currently, it's 9.69%. So that affordability calculation is done on the lowest cost plan that you provide your employees that provides minimum value coverage. So as an example, if that cost for your employees is $200 a month in 2017, that will be at 9.69. That means that $200 a month is affordable for any employees that have a W-2 income, Box 1 W-2 income of $24,767. In 2018, with it going back to 9.56%, if that employee contribution is still $200 a month for your lowest cost plan, now that affordability W-2 income on the employee goes up to $25,104. So if you have employees within that gap of 24/7 and 25/1, now with that new percentage, that $200 would be unaffordable for those employees. So you're going to have to do some work on that, on your employee contribution for those as well. 2018 employer penalties have not been released yet, but currently we do know the 2017 penalties, which would be for what we call the A penalty, that's $22.60, and the B penalty is $33.90. The A penalty, if you don't provide coverage. The B penalty is what happens if you provide coverage, but it's not affordable or doesn't meet minimum value. And yes, for our variable hour employees, we still need to manage the measurement period you've set up. Variable hour employees, as a reminder, are those employees that work plus or minus 30 hours a week. You know, those are the employees you don't know how many hours they're going to be working, and you can't tell. So you need to manage those hours. You still need to measure them to help define full-time status for those employees. And ACA reporting is still applicable. That said, the 2017 1094B, 1095B, and 1094 and 1095C, there's draft forms that are available. They're draft forms because they got to go through that, comment and rulemaking process. But for the most part, we think that those forms will the draft forms will end up being the final forms. So they're available if you want to look at them, but they're really, the only changes this year are on the B forms. There is no more transition relief. So the questions, I believe it's line 22, there's questions on A, B, C, and D, or 1, 2, 3, and 4. I apologize, I should have a form in front of me, but 2 of those are blank now because there's no more transition relief. And just to remind members out there that the B forms that are listed up there, those are for small employers that have a self-funded health insurance plan. So the majority of the employers out there are using the C form, and that is, the C form is for large employers that are both fully insured and self-funded. And as in the past, the 1095B or C, which most do the C form, that needs to be to the employees by January 31st of 2018. The 1094s and the 1095s, the 1094 is the transmittal form that you provide and include with all the 1095s that you've given to your employees. They need to be to the IRS by February 28th or April 2nd if you file electronically. So just things to keep in mind. We've not heard anything yet about any extension of any dates like we've had the last couple of years. For all employers, your maximum out-of-pocket, this doesn't mean everybody has a maximum out-of-pocket that's this high. You got to look at your medical plan, but the maximum out-of-pocket for 2018 for single coverage is going to go up to $7,350, and for those with family coverage, $14,700. So what this means is all of your deductibles, all your co-insurance, your office co-pays, your prescription co-pays, once those add up, and they keep adding up, the most they could add up to for an individual is $7,350 and a family $14,700. Now, you might have a medical plan with a much lower maximum out-of-pocket than that, but this is a guideline for those who are already pushing up with those max out-of-pockets. Your carrier could decide to increase it, the $200 or $400 over what it is this year. We don't have the 2018 FSA max contribution yet, and as you all probably know, currently we're at $2,600. And we still need to provide all the employees the medical ACA summary benefits coverage. Don't just rely on the employer or the carrier summaries that sometimes we see. The carrier summaries are nicer; they're 1 pages or 2 pages, but we still have to make available the FCCs that the ACA requires. And you still need for new employees to provide the Model Health Insurance Marketplace Notice. So that's what we have for all employers on the ACA. I also thought I'd throw in, this isn't ACA guided, but we're coming up on a new year and there have been some changes on high deductible health plans that are HSA compatible. 2018, your high deductible health plan minimum deductible is going to be $1,350 for single, $27 for family. So what that means is if you currently have a plan and that deductible is $1,300 single, $2,600 family, you're going to, it's automatically going to change. It has to be pushed up to the $1,350, $27 as of 2018. Now, for those of you that have a $1,300 deductible or $2,600 family deductible HSA compatible plan, that change doesn't have to happen January 1st if renewal is June. It will happen as firms renew starting January 1st of 2018. So your plan was, if you have a June renewal and you have that current minimum deductible of $1,300, $2,600, your plan will still be HSA compatible for the months of January, February, March, right up to June, as long as your plan and your carrier changes that to a $1,350, $2,700 as of the renewal date. Now, here's a guideline. Your carriers are going to do this for you. You know, we know all the carriers are up on this, and they're going to automatically increase those deductibles on their fully insured plans. But we also got to remind employers that maybe you have a higher deductible plan that you provide, and you provide a health reimbursement arrangement. If your health reimbursement arrangement is currently reimbursing down to the $1,300 and $2,600, your carrier won't tell you that you have to increase that. So it's going to be up to your agent to let you know that, you know, if you have to change your HRA, now you can only reimburse down to $1,350, $2,700. So if there's other moving parts involved, then, you know, got a little bit more work to do. And if you have an embedded deductible plan, one where the individual deductible is limited within the family deductible, that obviously needs to go up as well. And the new minimum deductible for an embedded HDHP plan is $2,700. On the other end, the high deductible health plan maximum out of pocket is going to go to $6,650, and then for individual, those who have single coverage, and for those who have family coverage, that maximum aggregate deductible is going to be $13,300. If your plan has an aggregate family deductible, and that deductible is higher than $7,350, the family deductible, actually within that plan, the maximum individual spend is $7,350. I'm going to try to not make this as confusing as it sounds. I apologize if I didn't do that well in placing this on the PowerPoint. But technically, if you have an aggregate deductible of $13,300, that means any one person in the family under the HSA guidelines can accumulate the $13,300. But we also have to remember that the ACA has a maximum spend guideline for anybody, any individual, of $7,350. So within that $13,300, even though it might be aggregate, no more than any one individual could spend $7,350 because of the ACA guidelines. And again, we've talked to the carriers on this, and most of the carriers are knowledgeable about this, and your plans are protected with that. So, you know, somebody should not, that has a true high deductible health plan, somebody with a high family aggregate deductible, that carrier should catch and not have that person pay more than the $7,350. So, and then the HSA contributions for 2018 are going up. The individual limit is going up to $3,450. It's currently at $3,400, and those who have family high deductible coverage that qualifies for an HSA, that's currently $6,750. It's going up to $6,900 for 2018. And then obviously for those who are 55 and older, there's still the catch-up contribution. That's not changing. That is $1,000. I like to remind people that for those of you that have and are contributing to health savings accounts, as soon as your spouse turns 55, your spouse can also set up and open up an account, an HSA account, and you can contribute the additional $1,000 in your spouse's name if you are contributing the maximum amount under your name and so forth. So probably best to talk to your bank custodian who has your HSA or your broker to make sure you work all that right. But technically, if you have family high deductible health plan coverage and you and your spouse are both over 55 in 2018, if you're able to do this, you can contribute the $6,900 plus another $2,000, $1,000 for yourself and $1,000 for your spouse into an HSA. So your total contribution for 18 could be $8,900. But there are certain guidelines on how those contributions work, and your spouse would have to open up his or her own HSA account to do that. So that's it. I don't have any more on the ACA today because this time last year everybody was kind of projecting what's going to happen with the ACA and maybe not last year but early in the year, but nothing's happened with our Congress, so it's as we know it today, and I hope you appreciated and enjoyed the webinar. Thank you.
Okay, so it looks like we did get a question during the webinar. The first question is, the $22.60 penalty, is that per employee?
It is per employee. Again, the penalty is only for large employers. It's if you do not provide coverage at all to your employees, or if you have a class of employees that do not get any coverage. So it's $22.60 per employee, but there's, in the calculation, when you determine the penalty, you take all your full-time eligible employees, you get to subtract the first 30. So if you have 100 employees that are full-time, subtract 30, and then you multiply it by the $22.60. So that would be 70 times $22.60. So that's how that penalty works on that penalty.
We still have some time for more questions, so please feel free to type those in the Q&A portion of the app. While that's happening, I'm going to just pull up Pat's contact information. So if you do have questions as you review the information that he went over today, you can go ahead and either call him or email him, and I know he would be happy to further the discussion from today. If we don't have any further questions, I'll go ahead and end the webinar. Thank you everyone for attending, and we hope that you found this webinar to be helpful, and we'll keep you updated as more information arises about ACA and so forth.
Thank you, everybody.